Well, it finally happened. The S&P 500 is now at a new all-time high. And since the beginning of the year, we are up 7.85% year to date. And from the bottom, which was in March, we're up 59.7% rally from the bottom. Okay, and those of you who watched my YouTube video in March where I called the market bottom, early April where I called the new bull market, you know that I said this was going to happen. The S&P is going to eventually make a new all-time high. It's just that it happened a lot faster than I thought. I thought it's going to take like a year for it to reach an all-time high. It's happened in less than 5 months. It's only August, we're at a new all-time high. So the question on everyone's mind is it sustainable? Is the market too darn expensive? Is it going to crash? Or could it go a lot higher? And are we only at the beginning of a brand new bull market that could last many, many years forward? I'm going to answer all those questions right now. And for those of you who have been loyally following my YouTube videos in my investing community and you bought near the bottom, congratulations. You should have done really well. Give yourself a pat on the back. And sadly, there were people who watched my videos and I told them to buy in early April, but they did not listen. Why? Because they rather listen to the purveyors, the peddlers of disaster porn. They listen to doomsday people, and worst of all, they listen to economists, right? Back in early April, right, what did economists say? They said that, hell is coming, right? IMF chief says pandemic will unleash the worst recession since the Great Depression. And this was back on the 9th of April. So many people, they read these news articles, they panic, they shit their pants, and they sell right at the bottom, right? And they sell here, making a huge loss. The moment they sell, the market goes up. And so I keep telling people, stop reading the mainstream news. Stop listening to all these so-called experts. You gotta follow the trend. You gotta look at the fundamentals of the companies, the most important thing. All right, so far, like I said, year to date, we're up 7.85%, and I'm really proud of all my students who have beaten the market, who have gotten double or triple the return from the market, right? As for me, I'm pretty happy. One of my portfolios, which is mostly my investment portfolio, you can see month to date, I'm up about 10%. And year to date, I'm up about 29% return, right? More than double the S&P 500. So my job every year is to help my students beat the market and for me to beat the market as well, right? My other account, which is mostly I now use more for trading, right? This account up about 11% for the month, and year to date it's up 34%, right? Now, if you think that's good, 20 to 30% return in just 8 months, that's nothing, right? I'm really proud to say that my students, many of them have outperformed me. And I say that, I'm really happy when my students do better than me. But then again, some of them are more aggressive, right? So I like to really recognize some of them and give them some of the due credit. One of them is, he's got a Vietnamese name that I kind of like blocked out. I don't want people to go to him and ask him for money, right, in Vietnam. But he said, "Dear Sifu Adam," his English name is Tony. I'm Tony from Vietnam. I'm very glad to tell you that since the beginning of March 2020, my investment account has increased 104%. My God, 104% to 217,000 US dollars. Okay. He said that the special thing is that I also help a few of my friends make money in Vietnam. I joined the Ultimate Investors Playbook and Options course since February of 2020, applied what you taught me to my investments, especially selling cash secured puts and stocks like Facebook, Apple, Alibaba, Amazon are up nearly 100%. Really happy for him, right? Another guy all the way from the US, Wally, right? After 2 years trading with Adam and 1 year with Bang, who is my options partner, I finally fired my money manager. Feeling great. I'm very conservative, but using a professional manager, I receive an annual return of only 2.8% with his investment manager. So he fired the manager and decided to do it himself. I took 20% of my funds to learn investment and trading with Piranha Profit. So far with Adam's teaching, this long-term investment account is up 28%. and my trading account up 52% year to date, right? So when you learn to do it yourself, you can double and triple the markets. Another Vietnamese Phuc, right? Don't think dirty, right? Doesn't sound like that, right? Thanks, Adam, for changing my life. I'm now confident with the US stock market while I'm still in Vietnam, right? And you can see that Phuc managed to achieve 53% return in the last, from January to August, right? Year to date. Amazing, amazing stuff, right? And then we have got Mr. Wong SF from Malaysia, right? Yesterday marks my small success in stock investment from being being new in the stock market by you 3 years ago to taking serious action 4 months ago, blah, 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 blah. I managed to double my capital and going to be financially free, right? So you can see that Mr. Wong's up 108% on his investment and trading account from Malaysia. And finally, Mr. Yuan Yi from Singapore, who's also one of my senior coaches. Adam sending you a message to share my year-to-date returns, getting 44% returns, right? So amazing stuff, guys. So back to the question. Is the market too damn expensive? Is there a lot more money to be made, or should we sell and get out now before the impending crash? So all this in this video. Now, if you watch the majority of YouTube videos right now, again, most of them will tell you that the market's, too expensive, it's at the top, it's gonna crash, it's unsustainable. And the same thing happens in mainstream media again, right? So on Bloomberg, they're saying that stock valuations hit a record and everything is expensive rally. Market experts say that stocks are too expensive, blah, 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 blah. And now I don't doubt that some stocks are really expensive. But to say that all the stocks are expensive, I would have to disagree with that. To say the whole market's expensive, I don't think it's entirely accurate, right? Now, first and foremost, why do people say that the market's too expensive? Why? Because a lot of them are looking at a measure known as PE ratio, the price to earnings ratio. And sure, if you look at the PE ratio of the S&P 500 and you compare that to its history, it looks insane, right? So in fact, if you take a look at the last 20 years, this is the PE ratio of the S&P 500, where the earnings are based on normalized earnings, which is basically based on the average earnings of the last couple of years, right? So you can see in the last 20 years, the lowest PE ratio, price to earnings, was 9.47, and the highest PE ratio is happening now on this day exactly, right? 36.4. And if you take the average PE in the last 20 years, it's 21 times earnings. So what does that mean? That means based on PE ratio, 21 is the historical average. Anything above 21 is expensive, below 21 is cheap. And right now, okay, we're at a PE ratio of 36.4, which is the current all-time high. So sure, if you look at that, the stock market as a whole looks insanely expensive, right? At 36.4 times PE, basically it's saying that the stock market is 73% above its fair value. It's 73% overvalued. Now, I'm here to offer a different perspective because I think that this valuation metric, index PE, does have certain flaws and does have certain shortcomings. And I'm going to offer you a different perspective that not all the stocks are expensive. Not all of them are. There are a few that are, but there are many stocks that are still actually cheap or fairly valued, right? So first of all, what is the flaw of this measure? Okay, so we are measuring right now the PE ratio of the index. And the index represents the entire market, right? So the S&P 500 index is basically the average of the 500 largest companies in the US, okay? Now, let's look under the hood and look at the actual 500 companies. And this is what you're gonna see, all right? Now, this is from Finviz, and this is the performance of all 500 companies since the March bottom, right, in the last 6 months. And what you can see is that in the last 6 months, the whole index has gone up kind of like 58%, right? 58%. But not all stocks went up 58%. Only the ones in green actually went up, right? So like Microsoft, Apple, Alphabet, Facebook, Amazon, Walmart, Procter & Gamble, Home Depot, Nvidia. In fact, it's just a few good stocks, right? But if you notice that the majority of the stocks, almost 2/3 of the stocks have not gone up, right? Have not actually gained, right? So you can look at the banks. The banks are still negative, right? In deep red, which means they're negative, right? Some defensive companies are negative. Utilities are negative. Energy is negative, right? Healthcare is more or less neutral, and so on and so forth. So in other words, it's not all the stocks that have gone up. It's only a few that have gone up, but because these few companies are so big, they take up such a big weight in the index that they pull the whole index up. Does it make sense? So think of it as there's a company of 500 people, and not all of them are working, right? Only like 50 of the staff are working, right? And it's because of the 50 the whole company does well. But the rest of the 450 are still sick. So it gives an impression that the whole market went up, but actually only a small percentage of the market went up, and the rest have not gone up yet. So is this good news or bad news? Well, it depends on how you look at it. Now, I look at it as bullish news. Bullish, right? Why? Because it means that, you see, the companies that have not gone up yet, they are very cyclical companies. They need the economy to recover for them to go up. They need a vaccine, right, which is now happening, right? So the moment the economy has more traction, the moment we get the vaccine going, what's going to happen to the other companies, the other 450 workers? They're going to start working, they're going to start coming up, and when they do come up, you're going to see that the S&P 500 is going to go up even higher when there's a broad-based rally. Does that make sense? Okay. Now, the next question you may ask is, okay, so Adam, those few companies that have gone up like significantly, right? Amazon and Google and Microsoft, are they too expensive right now? Well, some of them are, but not all of them are, right? For example, I can tell you that Microsoft is not that expensive. It's not cheap, but it's fairly valued. Amazon is fairly valued. Google is fairly valued. Apple is bloody expensive, right? So they're not all expensive, right? Why? Now, the other shortcoming of the PE ratio is this, right? PE ratio measures the price of the stock over the earnings, okay? But it does not take into account the earnings growth. So, for example, a stock like Microsoft may have a PE of 30 times. So you think that is expensive, right? But then again, Microsoft's earnings are growing at huge double digits despite the pandemic. Amazon's PE ratio is kind of like 100 PE, right? But then again, its earnings are growing at 50, 60, 70%. So the high growth justifies the high PE, right? So growth is not taken into account when you're just looking at PE. The other thing is this: the only true way to value a company is to look at how much money it can generate in the future. So a lot of this depends on growth, which is not accounted for in PE, okay? Number two, it also depends on the discount rate you use to discount the future value of the company's cash flow. And that discount rate is determined by the risk-free rate as well as the equity risk premium, which is not accounted for in PE, okay? So the best way to value stocks is through a discounted cash flow method that takes into account all these other factors. Now, if you do that, this is what you get, right? Now, I must give a lot of credit to my research team, especially Richard, who is one of my researchers, and he spent many hours to analyze the businesses and to put together this research report. I couldn't do it without my entire research team. So let me show you what we have found, okay? So out of the 500 companies in the S&P 500, we calculate their intrinsic value based on the discounted cash flow analysis, okay? Which is a lot more accurate than just looking at PE, because this takes into account equity risk premium, the risk-free rate, as well as the growth of future cash flows. And what we found is something interesting. Out of the 500 companies, okay, 118 companies, which make up 23.4% of the S&P, they are overvalued, highly overvalued, okay? So how do I define highly overvalued? These are stocks where the share price is selling 20% above its intrinsic value. So these are the stocks that you'll be insane to buy them. They're just too expensive, right? And it makes up 23.4% of the S&P 500. Next, stocks that are overvalued, which means they are over 10% to 20% above intrinsic value. They make up 62 companies, and they make up 12% of the S&P 500. All right, so if you add these two together, you get 35%. Does it make sense? So in other words, only 35% of the stocks in the S&P are expensive. Only 35%, only 1/3. Okay? Now, if a stock is selling within plus minus 10% of its intrinsic value, we say it is fairly valued. And currently, 152 companies, or 30% of the stocks in the S&P 500 are fairly valued. Okay? But interesting to know that we have about 33% of stocks that are still undervalued. Okay? So those that are undervalued and highly undervalued, right? So undervalued means they are more than 10% to 20% below intrinsic value. They make up about 13% of the index. And those that are very undervalued, okay, which means they're more than 20% below intrinsic value, they make up 21% of the index. So if you look deeper, you find that there are still many companies that you could buy that are fairly valued and undervalued, and only 1/3 of the companies are expensive. So it means that as investors, we should start taking profit on those top 1/3 that are insanely expensive, right? But for the 2/3 that are not expensive yet or undervalued, we can hold our stock, in fact, buy even more shares, because there's still a lot more upside potential to come for those 2/3. And if you want to find out which are the undervalued companies, the fairly valued companies, join us in our community of investors and traders, as well as subscribe to our Ultimate Investors Playbook, where I'll show you the companies that I'm still buying regularly in the markets, and which ones I'm holding, and of course which ones I'm starting to sell to take profits off the table. All right, so what does all this mean? So what I'm saying is that the stock market is not as crazy expensive as many people make it out to be, because it's only a few stocks that have pulled the whole index up, and those few stocks are not necessarily expensive if you take into account their growth rate, equity risk premium, and the risk-free rate. Like I said, I don't think Amazon is expensive right now. I don't think that Microsoft is really that expensive. I don't think that Alphabet is really expensive. I think based on their growth, their earnings, their current share price is very much justified. And like I said, when the rest of these cyclical companies, they begin to rally, like the banks and the industrials, I think that the S&P 500, it could run, or the bull run could continue for several more years. Okay? Now, a few statistics for you. Remember that if you look at history, how often does the market decline? Okay? Now, in the last 30 years, the market has dropped 5% 39 times in the last 30 years. So what that means is that on average, the market drops 5% roughly once a year. Okay? So once a year, we get a 5% drop. Next, out of those 39 times that the market dropped at least 5%, 15 of those times, the drop was more than 10%. So that means that on average, the market sees a 10% drop once every 2 years. And out of those 15 times, 6 of those times, the market dropped 20% or more and went into a bear market. Okay, so 6 times out of 30 years, which means on average, once every 5 years, the market drops 20% or more or goes into a bear market. Okay, so if you look at the historical statistics, what am I saying? I'm saying that I doubt the market's going to have a very big drop in the near future, because I know there are people saying, hey, I expect a crash all the way to the bottom, or I expect a 20% crash, I expect a 10% crash, I expect a 5% crash. Statistically, I don't see that happening. I mean, everything is possible, but I don't see that happening. Why? Because remember, a 5% crash happens once every year. And we just got it in February, right? Which means we have clocked our quota for the year. Okay, so I don't expect to see another 5% drop till another 12 months from March, which will probably be next February or next March, okay? And I don't see another big 20% drop like what we had for another 4 to 5 years, because we clocked our quota recently. In fact, there was another 20% drop in December 2018. So December 2018, we dropped 20%. In February 2020, we dropped 36%. So we're kind of like more than the quota, all right? So I don't think we're going to get another 20% drop for another 4 to 5 to 6 years. So that's my take on it. Again, I could be wrong. I can't predict the future, but I'm just looking at statistics, right? So does that mean that investors should jump in right now and buy the S&P 500 ETF? Does it mean you should go out there and buy stocks right now, buy Amazon and Facebook and Microsoft right now? The answer is no. No. Why? Because although I think it's going to go higher, but the market is now temporarily, technically a bit overbought. I would like to wait for a slight retracement of maybe 2, 3, 4% retracement. And I think it could happen sometime in September to October, because based on seasonality, the market tends to soften in September and October before the year-end rally after the US elections, regardless of who wins, okay? Remember that the market moves in wave patterns, right? So wave up, wave down, wave up, wave down, wave up, wave down. Breathe out, breathe in, wax on, wax off, right? So we always want to buy during a wave down to a level of support. We never want to buy on the wave up. Never chase the girl. Let the girls come to you, right? So right now, if you look at the market, yes, it's going to go higher eventually over time. But look at a wave, right? Wave up, wave down, wave up, wave down, wave up, wave down, and wave up. Small wave down, not really counted. Wave up, small wave down, wave up. So it's still on a wave up. It's still on a breathing out pattern. So it could run a bit further, right? I can't predict exactly when it's going to end, but I'm waiting for a wave down, right? Again, I don't think it's going to be more than 5%, but maybe 1, 2, 3, 4, 5%, 4%, wave down to the previous resistance that could now become support, right? Or it could even wave down to the 50 moving average. That could be an area to start accumulating shares of companies that are undervalued, all right? And of course, avoid the ones that are overvalued. Okay, so I'm still waiting for that pullback to add more shares, all right? And again, September, October, it could happen. Now, the other interesting thing is that if you take a look at the market internals, and I look at what is known as the advanced decline line. So this advanced decline line tells us the number of companies advancing versus those declining. So usually as the market goes up, you want the advancers to exceed the decliners. That's a strong rally, right? But if you take a look at the recent break of the market's high as the market went up, look at the advance and decline line, it's actually been slightly going down. So market's going up, index going up, but advanced decline line is not making new highs. We see a bit of divergence in the market there, which tells me that, hey, we could be getting a bit of a pullback in a couple of weeks, and I do hope it happens, right? Because I've bought call options on the VIX, right? So if the market goes down, I'm going to make a lot of money on my VIX call options. And I also I've sold covered calls on many of my stocks. So if it comes down, I'm going to make a lot of money on those covered calls as well, right? So I do hope that that's useful to you, whether you're an investor or trader. And with that, enjoy the rally, ride it all the way. All right, this is Adam Khoo, may the markets be with you, and I'll see you in the next video. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.